wither with the wind.
Okay, this is the New York City Park Hall. Meeting March 26th, 2017. Located on 27th Street, top floor, 5th floor, 30, New York, New York. Time is 2 minutes after 10. We'll have the roll call of trustees first. Janice Emery.
Here.
Susanna Vickers.
Here.
Justin Holt.
Present.
Steve Cassidy.
Edward Brown for Steve Cassidy.
James Slevin.
Here.
Robert Straub.
Here.
John Kelly.
Here.
James McGowan.
Here.
John Farina.
Here.
James Lamanda.
Here.
Sean O'Connor.
Here.
And Doug White, myself. We have 24 votes, so we have a quorum. We can start the meeting. We will start, I guess, with the performance reviews.
Okay, yes, thank you. So we have the quarterly report that we passed out, so everyone should have one of the big new State Street books. It's the first one from State Street. So what we wanted to do is just pass those out, and then if you have any questions, please ask us. We've got the folks here from private equity, real estate, and we're all here for any questions. Questions you can always ask anytime, but if there aren't any questions, we thought we'd just move them to the January report. Okay? Okay, great. Thanks. So then if everyone could put their monthly performance review books out. Okay, so these are the January numbers, and so you might remember we talked a lot about January and then even February. We have the numbers now to go through them, but as a reminder, so January was a very rocky month, lots of uncertainty, China slowing. What's the Federal Reserve going to do now that a new chairwoman is in place, Janet Yellen? Lots of nervousness about whether or not we were going to resolve the debt ceiling issue, which would happen in February. So in any case, the markets were down in January. Then what we saw in February was kind of the reverse. A lot of this uncertainty calmed down. But you might remember I also mentioned it'd be a rocky road over the next several months. And in fact, that's what March has looked like, kind of gone back the other way. But so why don't we just go then to the numbers, and it'll explain a lot. So if you turn to page 27 in the book. So if you look at the month of January then, just as a recap, the Russell 3000 was down about 3%. The EFA markets down 4%. The emerging markets down nearly 6.5%. You scroll down some more to the Core Plus 5, and it was up 1.7%. High yield up about 75 basis points. Tips up nearly 2%. And then convertibles up nearly 2%. So that was January. If you flip the page, this is what February looked like. So a lot of that uncertainty that dissipating a lot. The Russell 3000, you can see here, up close to 5%. EFA up about 5.5%. Emerging markets up over 3%. You go down to Core Plus 5, up about 75 basis points. High yield up 2%, tips up about 45 basis points, and then convertibles up over 4%. So a very strong month in February. The next page 29 shows you how it's split out in terms of where the return came from in January. And you know it's a negative number, so you can see the numbers in the bars here, where most of it came out of U.S. equities. So the 1 month total fund return for January was down 1.3%. If you scroll over to the fiscal year-to-date column, that would mean the total fund was up about nearly 9% through the month of January. Now, if you add in February what we just went through, which we estimate we were up about 3%, so that would mean that the Fire Pension Fund is up close to 12% for the fiscal year-to-date through February. which is a very strong number. It's great. If you then turn to the next page, 30, again, this is through January 31st. This is our asset allocation and how we're set up. You can see here the green bar to the far left, which is domestic equities, and then the blue bar to the right, bluish bar, which is Core Plus 5. We're now within the ranges, and we've been talking a lot about our rebalancing and reducing our exposure to U.S. equities to get back into these ranges. And similarly with Core Plus 5, and now you can see here that we're there. So that's good. And one thing this shows is up in the far left corner that Fire's AUM at $9.9 billion through January 31st. And I can tell you that as of March 21st, which was Friday, the Fire Pension Fund is at $10.1 billion. So again, a very good number. The rest of the pages now we have back in our reports the manager by manager returns, and then we also still have the private equity and real estate cash flows in the back. So if there aren't any questions on any of that, we'll move to the next item. All right, great, thank you.
Thank you.
So next up we have a risk presentation, and John Bright, our head of risk, is here with us. I think everybody should have.
You should have it's just 4 pages. But lots of words accompany it, so okay. Yeah, I think this is the third time I've talked to you all about risk. The first time we looked at our mark-to-market assets and traditional measures of the volatility of those assets and reached the conclusion, which was obvious before we even looked at it, that we have an awful lot of equity risk in our assets. The second time I came, I tried to pull in the liabilities and talk about our real risk not being that we lose money, but that we don't make enough money to actually meet our liabilities, and talk through various strategies there. What I'd like to do now, and it's taken me a while to get to this point, but I think really the best way to look consistently at our risks across both our assets and liabilities is to treat them all, give them all the same accounting treatment. So I'm going to mark-to-market everything. I'm going to mark-to-market our assets, mark-to-market our liabilities, mark-to-market implicit guarantees, off-balance sheet items, pull them onto the balance sheet, and mark them to market. Why would I want to do this? Well, one, it gives us a consistent yardstick to compare the risks of the assets and the liabilities. The other reason is accrual accounting or cash accounting is very slow to recognize that there might be a problem. By the time on a cash basis we recognize a problem, it's usually much too late to do anything about it. Mark-to-market sometimes will give false alarms, but because it's forward-looking, because it's looking at cash flows into the future, it gives early warning and may indicate things that we need to act on. And I'll remind you what mark-to-market is. For assets, it's what an unrelated third party would pay us for an asset. For liabilities, it's what an unrelated third party would charge us to assume our liabilities. And one of the most important things about mark-to-market is you recognize the gain or loss, not when the cash changes hands, but when the event happens that will cause cash to change hands. So if something happened today that obliged us to pay money in the future, we would, even if that payment was 10 years from now, we would recognize the present value of that payment today and mark to market. The other thing I'm going to do that's a little bit different is I am not showing you your fund separately. This is all 5 funds. This is the aggregate exposure of all 5 pension plans. I'm doing that because it's my belief that the risk can only be looked at on a consolidated basis. And I hope that'll become clear as we go through the presentation why I'm aggregating all the plans. So the first thing to look at is our income statement. And the first line will seem bizarre after Seema has gone through in great detail our monthly performance. I'm going to tell you that we will earn 7% this year on a mark-to-market basis, not a penny more, not a penny less. Because if we are so fortunate as to earn 11%, Bob North will take it away eventually. It will take years, but it's going to go back to the city to reduce the annual required payments. On the other hand, if we earn 5%, Bob will up the annual required payments from the city, and money will flow from the city to the fund. So on a mark-to-market basis, we're going to earn $11 billion, period. We also have, coming into the pensions, $9.5 billion of annually required contributions that the actuary has set. And these go up 3% every year. So next year it's 9.8 and so on it goes. I should point out one detail here. The CAFR shows 8.25. But that is because we have multi-employer plans. And some of these contributions are not made directly by the city, but indirectly by creatures of the city. I just lumped it all together into $9.5 billion. And we have employee contributions of about $800 million a year into the 5 pension plans. And these, again, the CAFR shows the headline number is, I think, around $1.7 billion, but that includes contributions to all fiduciary plans. So it's deferred comp, 457 plans, et cetera, not necessarily the pensions. So about $21 billion of income will come in. Now, we should take a look at the guarantee for a moment. Guarantees exist in the market. We could take our portfolio, pay the return of our portfolio to a financial institution, and get a fixed rate of return back. We could probably go out 30 years with that. We would get back 3.5%, not 7. That's the going rate for a 30-year total return swap. So of our $11 billion of income we will record, $5.5 billion of it is essentially due to the city's guarantee, either because the city actually has to pay the guarantee or that guarantee gives us the ability to take the risk to earn that money. So if I add that to the annually required contribution, that's $15 billion of our $21 billion coming essentially from the city of New York. This is why I'm arguing that we have to consolidate the risk. Each and every plan is facing the same obligor, the city of New York. If the city is unable to make its payments, it almost doesn't matter what you earn on your portfolio. The money that's required for these pensions for at least another generation, and probably beyond that, depends on the health of the city and the city's ability to make these payments. So if your fund does very well, and the other 4 funds have abysmal years, and more money has to pour in from the city, and the city can't make the payments, your principal asset, which is the ability the ability of the city to put money into the plan, is impaired. So you're all in this together. You're all facing the same obligor, and any one of you can impair that obligor. What are the outflows? Oh, I'll try. Yeah. What goes out the door? About $10 billion a year in pension payments. These grow at 3% every year. About $1.6 billion of non-pension payments. The bulk of these are loans that teachers and Board of Ed employees can make to their pension plan at high rates of interest, 7% for teachers, 8.25% for Board of Ed employees. So there are interest payments flowing from the pensions out to them through their tax-deferred annuity loans of about $1.25 billion a year. This is a very important piece of the puzzle because it's growing. It's compounding annually at rates of 7 or 8.25%. So these obligations are growing much more rapidly than any other obligations we have. And there's roughly $400 million of investment management fees. I know we spend a lot of time focusing on the management fees. They are a very minor piece of the puzzle. So we have $21 billion coming in, $12 billion going out. That $9 billion left over is being used to build the corpus. That is Bob North's plan, to build the corpus up to a point where, if we're lucky enough to earn 7% a year for the next generation, we will be less dependent on the city of New York, and the corpus, through investment earnings, will have a much better shot of paying the pensions. One thing, we need to earn 7% a year and continue making all the payments in to get to that point. The other thing we need is for the guarantee to not go up in value. 20 years ago, the corpus was $40 billion and the city budget was $40 billion. Today, the corpus is $150 billion and the city budget is $75 billion. At the end of a generation, when Bob has finished building the corpus up to where he thinks it should be, it will be 4 times the size of the city budget. Since the city is guaranteeing the return, the bigger the corpus is relative to the budget, the more onerous that guarantee becomes on the city. So we need 2 things to happen. We need to earn 7% for a generation, and we need interest rates to go up to a level where that guarantee is worth much less money. Let's skip a page and go first to the liabilities, because they're the easiest ones to understand the mark-to-market. What's the present value of the market value of our pension liabilities? Bob has them growing 3% every year. Out into the future, partly inflation, but largely presumed wage increases, adding employees, etc. Typical annuitization rate you could get from a third party is 5% or less. So if I discount these liabilities, which are growing at 3% a year, at 5%, the net value of them is $500 billion. Now that's the market value. That's roughly what you would have to pay a third party to assume the pension obligations. The non-pension benefits are substantial because, as I said, they're compounding at 7 and 8.25%, and it comes to real money. And that's about $120 billion there. And the investment management fees add a small amount. Now let me talk about the sensitivity of the liabilities. If interest rates go back up, suppose interest rates went up so that the annuitization rate was not 5%, but 7%, then the pension liabilities are worth only $250 billion. The best possible thing that could happen to us is to have interest rates go up a lot. I know it's counterintuitive because we look mainly at our assets and we think, holy cow, our assets get slaughtered. It doesn't matter. The gain in the reduction of the value of the liabilities is much, much bigger. The other thing that would reduce the liabilities is moderating the growth of wages. If Bob could assume we grow the liabilities at 1% rather than 3%, that has the same effect as interest rates growing. On the other hand, if we grow liabilities more quickly, that has the same effect as if interest rates were lower. And if we grew them at 4%, then the liabilities are worth $1 trillion. So what does that mean for our assets? So we have roughly $640 billion of liabilities. Balance sheets must balance, so we have $640 billion of assets. Employee contributions, the stream of those, present value is about $40 billion. We have $150 billion in securities across all 5 plans. That leaves $450 billion of value that we are essentially owed by the city on a mark-to-market basis. This is an extremely large number. To put it in perspective, the city has about $45 billion of general obligation bonds outstanding. So this is 10 times the indebtedness of the city. What can we conclude? Our best hope would be interest rates go up dramatically. But if we are in an environment where interest rates stay low, this is just too big of a gap. If interest rates stay low and we continue on the path we're on, I think I know what will happen. At some point in the future, we're heavily in equities. We'll hit a bad patch. Equity markets will crash, our returns will be dismal for several years running, and the city will be required to put in more money. And there won't be room for it. We won't want to cut services anymore, there'll be resistance to raising taxes. And what will happen is we will spread the required payments as other places have done, not over a generation, but over 2 or 3 generations. Or we'll cut benefits for new employees. Or eventually new employees, if it's bad enough, end up in 401ks. And this will be a pity. Because the defined benefit plan has a huge advantage over defined contribution plans because it evens the pain out over cycles. If you happen to work during a period when returns are very low, you don't get punished because you happen to live in that period, but we spread the wealth over many generations. But at the core of that is intergenerational equity or fairness across generations. If one generation takes too much for itself by assuming unrealistic earnings rates so they can take more now because we'll make it up later, or by harvesting gains prematurely through resets and spending the money and not leaving it for the future generations, or by using the pensions to subsidize other benefits, they put an unfair burden on the future generations. And we have tended to err in that direction. So my strong advice to everyone is the time has come to err in the opposite direction. Because if we don't, and if interest rates don't go up by a lot, we will not be preserving the defined benefit plan for future generations. So I would suggest a few things. One is, ideally, we would drop the actuarial rate to 5%, just to make sure that we're conservative enough to provide for the future. Of course, that's impossible. The required payments from the city would be tens of billions of dollars greater in money it does not have. But we can behave as if we did. If we're lucky enough to have a run of very good years, we should not let Bob reduce the actuarially required contribution. We should be putting the money aside for the future generations. The other thing we should do and think very hard about is if equity markets have a few more good years and interest rates are as low as they're, should we be trying to earn not just good returns, but spectacular returns while we have a window and put all that money aside? And to do that, I think you should think seriously about leveraging the portfolio. Not at rates of 7 or 8.25% like some of the other funds have done, but at the 25 basis points rate you can get from the market. But if we could take that risk now and put all the money aside, don't spend it all, I think we have a real chance to plug this gap between liabilities of $600 billion and assets of $150. It's too big right now.
What scenario would that leveraging the portfolio not work?
Let's say we locked in 5 years of leverage. You could probably do that for a point, bro.
Oh, so you could probably do that
For 1% interest. If over 5 years, the fund then earned less than 1% on the average, we would lose money. But of course, if we've earned less than 1% over 5 years, we're so far behind the actuarial rate, we're dead anyway. Where leverage really hurts you is if you have a solvency event. So you have the market goes down, you don't have enough assets to pledge against the loans, and you're forced out at the bottom. We have enough assets that would not happen to us unless we put on way too much leverage. But really, if we think we're going to earn less than 1% on the average for the next 5 years, we should go home.
I don't see rates going up anytime soon.
No, but we need it to happen in the long run, just to bring the value of the liabilities down. My fear is risk managers always assume the markets will do the thing we don't want them to do. And so I assume we're never ever going to see, a 7% long bond again. And that means annuitization rates will stay low, and that means that this will remain a colossal burden on the city and may get worse unless we earn a lot of money quickly.
I guess I would make a suggestion that maybe the next time we talk about this, we make sure that Bob is here, because I think he would have a lot to contribute to it.
Yeah. Bob has been at the earlier presentations. He just wasn't here for you all. But it's the identical presentation each time.
The other thing that would be helpful is to have this type of analysis that was just focused on fire, pension, and assets.
It might be, but I think it's really not relevant because it doesn't matter. The other guys can take you down because I wish we could only look at you as if you were segregated, but you're so dependent on contributions from the city that the risks are consolidated. They are.
I agree that that's an issue. But I think that, so the ultimate question that I hear, one of the ultimate questions is, what should be the risk profile of this fund? Should we be pulling harder on the investment lever to try to catch up? Or should we, maybe should we pull back on the risk because, at our current fund status, if there was a 15 or 20% equity market correction, where would that put us? Would that put more pressure? Would that story you just told be, 5 or 10 times worse if the assets were down 10 or 15%? And is that investment on the investment side, is that trade-off there, or is it not?
And remember, you're a small fund. So if you leverage and no one else does, it doesn't matter also. You really have to coordinate with the other funds. Because in the end, if you have a lot of money and they don't, it doesn't help. And from a risk point of view, and you're already consolidated in my mind, and you really have to work with them and come up with a strategy. It can't be done in isolation.
And so some of our clients have put leverage in place, but I think there's a lot of conversation that has to happen before you go down that path. I mean, one of the things that they've done when they put leverage in place is they reduce the risk profile of the fund, so that you're not just levering up equities, you're creating a better balance with a lower risk portfolio and then capturing essentially the spread between your borrowing cost and the yield on even just bonds and long bonds.
Yeah. No, there are many things we could do.
I think there would have to be a lot of education and conversations.
But all I'm saying is the time for those conversations and education is now. If we wait another 5 years before we do anything, it may be too late.
So,
too late in what sense?
Too late in the sense that we hit a bad patch and the city cannot make the new payments, and we're on the path toward the end of intergenerational equity.
And that may happen either way we go, if we stay the course of what we're doing or if we lever up the portfolio.
Yes, it could. But in the end, doing nothing, to me, the mark-to-market is telling us that we have a problem, and the time is to start thinking about it seriously is now.
Well, so this year is important because GASB has new regulations that are taking effect where the city has to look at that discount rate, and the new regulations require to look at, whether there's kind of an arc of where the plan would, in theory, actuarially run out of money, and then do they have have to discount the liabilities beyond that point at a lower rate.
Right.
And so I think that will have a lot of relevance in the conversation. I think the city and this board have done the right things in terms of lowering the discount rate by 100 basis points in the last 2 years.
That has been, yes,
And
it's
I
in the
think
right direction.
You keep having those conversations, and when you lower your discount rate, you're saying to the city, we need you to put in more money. And I think that conversation is always going to be tied to the city's ability to do that. And I think everyone on this side of the table understands that and understands,
No, as I said, we cannot go to 5%. The city doesn't have that money. But all I'm saying is we can behave as if we had. And we can not harvest gains prematurely. We may have a very good run of equities for the next few years. It'll be incredibly tempting to take those gains, reduce the city's payments, declare victory prematurely. And that's what we have to watch for. But these are all things we need to think about now, not wait until a crisis is upon us.
So as a follow-up to this discussion, then, would you suggest if Bob's back, we can huddle together with John?
Sure.
Try to come up with a
yeah,
framework to think about this, maybe look at our asset allocation and considerations around it.
yeah. And I don't know how far he's gone down the path of looking at those GASB calculations. He may already have them done. Or he may
Bob
be
has come
working on
very close. That will be very different from marking everything
it.
tomorrow.
Well, but it's going to trigger more of, it's going to
It will
get us
start
further
moving
down
people
the
in
path
that
of this
direction.
conversation.
Yes.
Yeah, sorry, Todd. But I think that's more of a second half of the year conversation when we have the GASB calculations done, the CAFRs, those disclosures are starting to come forward in draft, and then, obviously Bob has had a chance to kind of weigh in on this.
Right. Okay. Well, so yeah, this was just intended to start a conversation, start a dialogue, and I think it's good that we're doing it now. But we'll come back, we'll circle up and come back. Okay.
Yeah.
Okay, so next up we have the emerging market debt education piece, and I think Doug has a handout, maybe, or is it just in the book?
It's just in the book, actually, I'm sorry.
All right, then I guess that starts on what?
It starts on page 120, 120, 120 of the book.
Okay, so Mark, you're gonna check it out?
Thanks. So before Doug starts on all about what you want to know about emerging market debt, I want to tell you about why we're talking about that. And the reason we're doing this is because there's another New York City system, teachers, that's doing a search on emerging market debt. Presently, if FIRE wished to do a search today in emerging market debt, it couldn't because of the basket limitations. We'd be pressing up at this point against the 25% limit.
Are the teachers invested in emerging market equity?
They are.
They are now.
They are. Right. Teachers doesn't have hedge funds, so that's the difference. So if FIRE wished to do this emerging market debt today, they couldn't. But in the event of change in legislation, and given that we're doing a search anyway for teachers, we thought it would be a good idea to talk about emerging market debt. Doug will tell you all about everything you want to know about emerging market debt, but the ultimate thing that we're looking for is for the board's okay for us to use NEPC services in the search that's going to happen anyway for teachers. This way, in the event that the legislation happens, and subsequent to that, the board decides with that legislation that it wishes to invest in emerging market debt, it would be able to do so fairly soon and fairly immediately, pretty much by the end of the year, once the search is done. If the board didn't do that, and it wished to do emerging market debt, we would have to do a whole new search at that point. By the way, I would call this a free option. What I mean by that is, what I just said is, if the board wishes to do emerging market debt, if the law is changed and the board decides not to do emerging market debt, there's no obligation to do so just because NEPC participated in the search. We simply won't move forward with it, with the recommendation. That would be a board decision. So this is, like I said, a free option. We can tag along with the search if the board wishes to participate because the ability is then available to do so. We can. And at that point, we'll talk about policies, things that Doug will talk about a little bit later. But that's for a later time when we're able to do the search. But for now, we're looking for the board's okay to use NEPC on the search. And I'll let Doug talk about EMD and what he thinks about EMD overall.
Great. So starting on page 124, so I guess I would say, and I've said in the past, that NEPC has recommended to all of our clients that they consider emerging debt a separate asset class. So similar to high yield, you could think of it as a specialty fixed income area. It involves more return, but also more risk than Core Plus 5. The New York City systems have historically had probably a little bit of a lower allocation to any non-U.S. fixed income in part because of basket clause.
I want to clarify that because, as you know, non-U.S. equity, we're allowed 10%, so above 10% goes to the basket. But for fixed income, any non-U.S., there is no 10% rule. Any non-U.S. denominated fixed income goes in the basket. And because of the relative returns of equity to fixed income, it's a bad use of the basket. So we haven't had a non-U.S. fixed income portfolio.
So we've typically recommended allocations of between 3 and 5 or 6% to clients. That's been an area over time that's done very well. Last year, it did not do as well, which means from our standpoint that if the market in the emerging debt space was down 5 or 6% last year, the prices there actually got more attractive. They were down. Yields have come up. And over time, we see, while the risks include, what you would characterize as credit risk, the risk of lending to these individual sovereign countries that are just like the U.S., individual creditors, but also in the corporate EMD space to individual companies in these markets. So that involves credit risk, interest rate risk, similar to the rate risk you're taking with the duration of your bonds in the U.S. markets. And then also country and currency risk. So the idea that a market like Brazil has issues bonds in their local market and they're paying say a 6 or a 7 or an 8% coupon, if the currency moves up or down, that impacts your total return. So the currency risk is part of that. So I'm going to start on page 124 of the book, which is page 5 of the NEPC page numberings, and just talk a little bit about what happened last year in some of the emerging markets. There was essentially, in the equity markets and the fixed income markets, are sensitive in terms of the pricing to the growth outlook for any country or company. And if you look at the top right chart, the BRIC GDP growth rates, what we show here is that there's a 10-year average, which is the bar that's on the left-hand side in each column. And you can see the higher numbers, the 10-year average for China, for example, their growth has been over 10%. If you look back at last year, at the end of 2012, the market was projecting a consensus growth rate for China of close to 8%. Similarly for India, it was over 5%, and you can see the different other countries there, most of them over 3 or 4%. During the course of last year, there was a repricing of the growth expectation in those markets, and you can see that the dark black chart on that page shows where it was kind of earlier this year, where those growth assumptions have come down, in particular for different countries like Brazil and Russia, more so than China and other countries. And so that's part of the story of why the markets underperformed last year. But over time, I think when we look at the bond yields in those countries, we believe investors are getting compensated for taking those risks. We also think that when we look at the problem in terms of the balance of payments, the money that flows into these countries to invest and sometimes flows out of these countries, that the emerging economies are in a better position to manage that because they have lower debt per GDP, lower debt per citizen in their country, and they have higher GDP growth rates. So in general, while they may be more volatile, they are over time growing at a much higher rate than the U.S. and other developed markets, and that makes them more attractive. The other thing that we see happening is that their credit quality is generally improving over time, whereas the credit quality of the developed markets that many of our clients are very comfortable with is actually deteriorating slowly over time because of the higher debt levels. And I'll have some charts on that later in this presentation. On page 6, you can see the reserves as a percent of GDP. Many of the emerging economies have large surplus reserves that they use both to manage their economy but also their currencies, whereas other countries like the US, the UK, and Germany have a very small percentage of their GDP set in reserves to manage those types of things. The developed markets have clearly benefited from being perceived as the safer markets in terms of bonds or equity markets, and so they have a large amount of flows from outside of their respective countries that flow into those markets. The emerging economies that has been the case as well in many of these, but in general, if you think back to the late 90s, the Russian debt crisis, and some other economic crises associated with emerging markets, one of the issues then has been a currency collapse. And in response to those conditions from 10, 15 years ago, many of these countries now have larger reserves that they use to manage the currency volatility. As I mentioned on page 7, EMD was the worst performing risk asset class last year. So we believe it is, while there is still a lot of volatility this year, you're reading the papers about issues in Turkey, issues in Brazil. Brazil actually just got downgraded. We think it's a great time to start this process of evaluating these products and look over the next 6 to 12 months to be able to put an allocation in place as long as the basket is changed to allow for that and give us room for that. When we look at these strategies, and I'll go through some of it in the history of the emerging markets was that if you go to page 9, many of the emerging markets economies, when they needed to raise capital, when Brazil, for example, needed to raise capital, they would do a bond offering in the U.S., in U.S. dollars. And they'd go to the U.S. market because it was the most liquid, had lots of investors, and raise capital there. And we call those, dollar block bonds or hard currency bonds, depending on your point of view. And so that was really the market for a very long time. And really over the last 10 years, what's happened is many of these countries have started their own bond markets. They've started to issue debt in local currency dollars in their own markets, and investors have had to essentially buy those currencies and purchase those bonds in those local environments. The other thing that's happened is the corporate bond markets in those categories in those different countries has started to develop as well. And so that's been a pretty good story really up until last year or so. Even during the downturn in 2008 and 2009, many of these economies stayed more resilient than the developed markets economies, even though we realize that they're very heavily linked. Certainly their growth rate, improvements in labor costs, manufacturing, the rise in commodity prices have all benefited many of these emerging economies. You see on page 10, there's a chart that looks at just the grouping of emerging economies' growth rates versus the developed or advanced economies. And you can see that dark black line, which represents the advanced economies. The growth rate in most developed markets has been, kind of anywhere between 1% and 3% for the last several years, and projected to kind of stay in a range between 2% and 3%, with countries like Japan and the Eurozone tending to be below 2% right now, the U.S. kind of somewhere between 2 and 3. But because of the heavier debt load that has built up in the developed markets economies and some of the other trends with labor costs, it's been harder for those economies to grow at a rate that they had seen in the past, which was kind of north of 3% or 4%. And so we believe that looking out over the future, whether you believe the emerging economies are going to grow at 5 or 6% as a group, or whether it's 4 or 5%, it is still a much higher level than the U.S. economy, and that will provide opportunities for those debt markets to continue to mature, for the credit quality of those countries and the corporate issuers to continue to improve, and that you are being well compensated with a 6 or 7% yield for investing there. The other part of that story, page 11, is the fact that globally the emerging economies, both when you look at it on GDP, a GDP base, or look at the wealth effect of what's going on with their underlying citizens, those economies are becoming a bigger piece of the overall pie. So even if we said to you, let's invest, let's index our equities or our fixed income to the global market cap of the world. Look at the whole global market value for bonds, and let's just kind of index it. We would have a bigger chunk. We'd obviously have a slice in emerging debt, and we don't right now. You can see the chart on page 12 has the information on the reserves. If you turn to page 14, look at how the yields and the volatility in the pricing of these bonds has kind of had different spikes, and there are definitely periods where the risk in the emerging markets is reflected in the pricing, and the volatility increases. Last year was an example of that. When the taper talk started in May and June, many investors perceived that to be a negative for emerging debt and equities, because that meant that if rates were going to rise cyclically in the U.S. and maybe more sooner than people had anticipated, there would be a pullback of capital from the emerging debt area, and that's essentially what happened. Is when you see these spikes in volatility, generally the market is getting the yields are widening, spreads are widening, and the prices are going down, and they're becoming more attractive. And we see that condition right now. It's similar to other periods in the past, and certainly we believe that makes it more attractive. If you go ahead and skip ahead to page 18, I'm just going to talk a little bit about how emerging debt would improve the risk and return characteristics of your policy portfolio if you were to decide to move forward. We think that taking an allocation of 3% or so out of the equity category will actually balance your risk a little bit better. It'll reduce the equity risk in your portfolio a little bit further. We've already done that over the last 3 or 4 years. We've taken big chunks of money out of equities, put them into hedge funds, increased our private equity allocation. We think that this would be the best next step to continuing on that path of reducing the asset risk in your portfolio while trying to maintain that expected return so that we can still project a return that's in excess of that 7% actual target that we just discussed. Again, there's a big yield pickup in this category over Core Plus 5, which I think is yielding closer to 4% right now, or maybe a little bit less than that. And this category is yielding more like 5.5% to 6.5%.
I'd also like to point out that it's the yield is comparable to, or many times higher than high yield, which is lower in quality.
And we have similar assumptions for the risk in those categories. When you get into go to page 20, when we get into a discussion point about managers at some point potentially in the future, we would have a discussion about how we would want to select products that either focus on the local currency bond market, the dollar-denominated bond part of the bond market, or even the corporate bond market in that sector. And essentially, when we look at it, we see all three as being attractive, and the ability to kind of look at those three areas. Many of the products that we would examine in an RFP would have what we call blended products, meaning that they would include allocations to all of these categories and be able to adjust a little bit tactically, because they are very similar, but they do have differences in the impact that currency has on them, and also in the yield and credit environment. Some of the benchmarks are highlighted on page 21 or page 140. Again, there are benchmarks for hard dollar or U.S. denominated emerging markets. You can see the number of countries there is much larger because there are a lot of small countries that really haven't gotten their local bond markets started yet, and they still come to the U.S. and in some cases Europe to raise money. The benchmark in the middle, which is the local currency market, is really focused on the 16 larger markets. So while there may be new countries that are added to this over time, essentially the benchmark in this space is focused on the larger economies that are already issuing debt in their local markets. And then the corporate bond market is still relatively small. You can see at $280 billion. That has been growing pretty exponentially each year, but it's still, Martin's comparison to high yield. The high yield market is well over $1.5 trillion in size, and I think it's closer to $2 trillion now. This market is, really closer to 15 or 20% of that size. So still emerging. And then really that's it. That's all I had. I don't want to necessarily go through all the other pages. Again, we think it would be beneficial. We have the return assumptions in the appendix if you want to look at those. The correlation to the U.S. market is the other part of that story when you look at it as a policy mix perspective. And the correlations have had periods where they show there's a diversification benefit in owning these bonds. And so we think it makes a lot of sense to participate in the ERFP that the teachers are doing, and then get down the road and decide after hopefully the basket issue is resolved how to move forward.
So the next steps for us would be for you're okay for NEPC to participate. We will obviously be looking at, there's many different areas, as Doug mentioned. You have corporates, you have sovereigns, you have hard currency, you have local currency, you have plans. We'll come up with a mix of managers, and the board can then decide if it wishes to create an allocation to emerging market debt or not. If the board wishes to do so, we'll come up with what we believe is the best mix to come up with, because we're creating it from scratch, and so we'll come up with a policy. But that's down the road after the search. So the next thing you'll see from us is a scope for a search.
And can I just ask a question? Will this search be focused on the type of blended, more unconstrained manager that NEPC is recommending on page 27?
I'll let NEPC answer after I give my comment. And our comment is that our observation and our education that we did ourselves and our work that we did with talking to different managers is that managers themselves are extremely active in this space. It is not unusual to see the tracking error extremely high, 4, 5, 6, sometimes 7%. What that tells you is that either you have the wrong benchmark, or the benchmark isn't really being paid attention to because it's not really representative of the opportunity set that's out there. So the blended part is a big part of it. Many managers have blends out there. Many managers have different flavors out there. In fact, in the eVestment Alliance, I believe we counted there are 6 different universes. So part of them are blends, some of them are hedged universes, some of them are corporate, some of them are sovereigns only. So we will be looking at all of them to come up with the best opportunities, since we're starting from scratch, to come up with the best opportunities for the board. And yes, managers that don't presently do that obviously have the opportunity, but we would prefer managers that have shown an expertise in doing the blends to be recommended for the board. But
so
that's
is that a yes?
That's a yes.
Okay, thank you.
Jim, you got a comment too?
Just, we've discussed it, and we're interested in participating in the search. So I don't know if you need a vote.
We, you mean UFOA and UFA?
Yes.
Thank you.
Right.
Yes.
Well, does it require board approval, or is it part of NEPC's mandate?
It's part of the mandate. I know
the scope.
yesterday we did another. It's part of the searches. Searches are part of the contract. We did it in another board yesterday. We did not require a vote, so I don't know that we need a vote.
Okay.
Okay.
Thanks. So next we have a handout that has out on the emerging manager MWE
Controller has, thought a lot about this and has been talking about it and wanted to go before all the boards and just let you know sort of where we are in beginning to pull together a plan to try to dedicate some resources to emerging managers. SEMA's going to sort of take you through the plan, but it's in development, and we just sort of wanted to give you an initial look at what we're thinking.
Thanks. So the idea here is to expand the Emerging Manager MWBE program that we already have. By expand, it means to add additional dollars, and where we're planning to add additional dollars is within these three asset classes you see here: real estate, hedge funds, and opportunistic fixed income. A couple of these areas, as you know, hedge funds and OFI, we do not yet have money allocated to emerging and MWBE managers, and we've been working on that, and so we're looking to come to the boards in the next coming months with some ideas around that. We have some money in real estate today, but it's a small amount relative to the total allocation, and we have some interesting opportunities, we think, there that we would want to come to the board on, again, in the coming months about how we think about this. Additionally, so not just dollars, we also wanted to expand our thinking around building relationships with the managers in the community, where we already have them, and then those where we don't have those relationships, and just expanding it. So as part of that, you might remember last year we did an investment management conference. We're doing it again this year. It's April 25th. All the trustees are invited, so please put that on your calendar. It should be a very large event. It should be good. We'll have our existing managers come, and then we'll have potential managers who want to do business with New York City come. There's a big morning part, and then the afternoon will be a bunch of breakout sessions by asset class, where this is primarily for those folks who don't yet do business with us, and it's just, okay, how do I do this? Who do I talk to? And so again, we'll have these breakout sessions by asset class, so that'll be good. And then, as you might remember, we've done these dinners in private equity, where you have our large managers introduced to smaller managers, and so they can learn best practices about how do I do this, how do I get to the next level. We did it also in hedge funds, but in this case we want to broaden it out. So we plan to do many more events around the idea of getting more managers together and talking about best practices and having them meet our consultants, having the consultants have these managers on the radar screen and that kind of thing. Another piece of this is a graduation policy, which I know you guys remember we've talked a lot about as well, where currently we're still not yet able legally to form a direct contract with one of our sub-managers within these fund-to-fund portfolios without doing an RFP. We were close. We thought we were able to do it last year, and we just couldn't get that done. And so we're going to try again. And so we're working internally about how to do this and structurally, how do we do it. And we've already had conversations. So that'll be a part of it as well. So I think that'll be good. I mean, as we all know, a great part of this emerging manager program is you invest in a smaller manager, they do really well, and that's wonderful, and we want to participate in that success and maybe have more money with that manager, and yet we can't without doing a whole other RFP. So
yes, Seema. In the past, when we did promote, for lack of a better term, the smaller managers to developing managers, I believe we did 2 or 3.
But we had to do it under an RFP. That was the problem. It's not a problem, but that's the issue.
I'm talking about a number of years ago, right? I don't recall there being an RFP.
There was one.
There was, okay.
There was one.
But
It was
we
the
did
only
pick,
way.
my question is, we did pick from among the smaller managers that were part of the fund of funds of the 3 emerging manager fund of fund managers that we had.
Right.
Is it going to remain the same, or are they going to include smaller managers that are not part of, of those fund of funds that we currently have?
So that would always be done with a search. So you might remember we came to the board a couple months ago, and we talked about extending these developing manager contracts for 1 year, but then they're done. So we want to do a developing manager search. So that's separate, though, from what we're talking about within these fund of funds. Because what we'd like to do within these fund of funds is, as you know, we've got all these underlying managers that, you know, in many cases they're 10 or 15 in each of these portfolios, and we don't have direct relationships with those folks. So without having to do a whole other RFP, which as you know takes time, we can now, once we get this figured out, is to be able to say, that manager did really well, they hit $2 billion in size. We normally tell the fund of funds to kick them out because they're no longer an emerging management. We don't want to kick them out, we want to still have, you know, money with them. But there's no way, there's no mechanism right now for us to do it without doing a whole other RFP. So that's the idea behind this graduation policy, is that we don't have to do any research. We can just go to record. That's the plan. And I do think it will help us invest with these smaller managers that grow up and mature much more quickly.
So to qualify as a developing manager, in other words, your assets under management have grown to a point where you're not the smaller manager anymore,
That's right.
but you're eligible to be part of our developing managers' investments.
That's right. Yep. Exactly. Because the way we define developing managers is anyone from $2 billion to $5 billion in size. Correct.
Right.
Yeah, that's right. So that's that piece. And then, you know, we have an open door policy, which we've had for years. One thing, though, I don't think we did as formally, and we want to do now, is have one designated person within each asset class to be the point person for all the emerging managers and all the MWBE firms that either do business with us or want to do business with us. You know, we have Mark Rose, who's been doing it in public markets for us, and we have Alex Domingue, who's been doing it in private equity for us, but that has been kind of it. And so what we want to do now is have one person in hedge funds, one person in fixed income, et cetera, et cetera. So that we think this will just make it easier for folks to contact us and not have any issues there. So that's another element of it. And then lastly here, as I talked about before, we're doing a developing manager search, and we'll be coming back to the boards with sort of those specs of what we're thinking about in the coming months. So that's the gist of it. And we'll be formulating the dollars, again, over the coming month or so, and we'll bring that to the board.
Can I just say, thank you for providing this. This is very useful to us, and I think beneficial to the fund as well, because I have seen studies in the past that do support that smaller managers tend to outperform because they control their size. I would just ask that as we're introducing new asset classes, smaller managers and new asset classes, that you come to the board like you did with the emerging markets for fixed income and educate us on the investment case for it before, before we have a search or before we make a final decision.
Absolutely.
Thank you.
Seema, did you finish that part of the agenda before we move into the herbal supplements?
Yes, there are any other questions? Yep, we are finished with our public part. Pension.
Well, we need a motion to move into the firefighter variable supplement public agenda. Second. Any objections? Hearing none, motion carries. Let me just read off the names of the folks. Janice Emery.
Here.
Susanna Vickers.
Here.
James Snowden. Here. Robert Strong.
Yeah.
So we have 5 minutes now.
The only item we have is the quarterly report, and unless you have any questions,
My only question is, looking at the report, the firefighters variable supplement fund has grown since the last report we got.
it has done very well, as has the fire pension fund, which is now over 10 million.
Right. No, that was good news.
So who takes credit for that?
I do.
Okay.
Good answer.
Come on, that's why I directed it at you.
Okay, if that item is finished, we need to now, I guess,
Motion to close the firefighter variable supplement fund.
and move into fire officer variable supplement. Okay, so the fire officers, that would be Janice Emery.
Here.
Susanna Vickers.
Here.
James McGowan.
Here.
James Lamunda.
Here.
Okay, so 5 minutes on this one.
Same item, we have one item on the agenda, which is the quarterly report for December, unless you have any questions. That's all we have. I do want to point out that the benefit that was paid January 31st is not reflected in there, which was about $25 million.
You answer that question? You took your question. I have a question, so I'll make a motion to adopt the,
We need a motion for that? You said to adopt the report, right?
Yeah, accept it.
Oh, okay, accept the report, okay. Since you said a motion, so it's a second. Objections? No objections? It's accepted. Okay. We now need a motion to move out of the fire officer variable supplement into the executive session. Do I have a motion?
So moved.
I'm sorry. And is there a second?
Second.
Any objections? Hearing none, motion carries. Let me just say that